per guidance show. Do you have that diagram I wrote last time? This one here. Okay, okay. So we can begin. Always, as you've said, it's your guy. Always, always. Mm, yes, yes. Okay, okay. So we start. We ended on transaction number 7, which says paid tempo by check 1,500. So, yes, so if we remember, earlier on, we bought goods from Tembo worth 50,000. So we're owing him. Okay. Yes, we're on number 7. So I'm just going through the a recap. Okay. Tembo is our creditor, is a liability. Okay. Now, since we're paying him, which two accounts are involved in here? Uh-huh. Mm-hmm. Yes, we're paying. No, no, drawing. Uh-huh. But drawings, no. Drawings is when you draw bank and our liability. No, 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 no. Our liability term. Okay. There is bank and our liability term, our credit. Okay. Yes. 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 You are getting it now. Yes. All right. So paid Tembo by check 1,500. So the two accounts involved are bank and Tembo. Bank, yes, bank is an asset since we are paying, so it's a reduction in an asset, right? Reduction in an asset, we do we debit or credit? No, 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 no. Remember, assets increase with debit. No, 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 no. No, no, that's in bank terminologies. Yeah, no, don't worry. No, it's I understand what it's. In this case, what you're going to do is this: you're going to look at the double entry rules and say, okay, assets increase with debit. So since we are paying by check, so our assets is reducing. So if an asset reduces with debit, I mean, if it increases with debit, then it reduces with credit, right? In an asset, yes. So we'll credit bank. Then Tembo is a liability. Liabilities increase with debit. Now, since we are paying Tembo, our liability is reducing, right? That's on Tom's bank account side. As we're dealing it from our side. Yes, from our side, our bank account, our bank balance has reduced because we're paying. Credited. Yes, it's debited. Then a liability. Since we are owing Tembo money, now we've paid him. So then Congole is dropping down, right? So reduction in a liability, you debit. So you're going to debit Tembo, you debit Tembo 1.5, and you credit bank 1.5. Mhm, mhm. Then it means you're increasing your bank balance. You're increasing it. You're increasing your bank balance if you debit. And in this case, that will be wrong because your bank balance has to reduce since you're paying out. Yes, yes. No, no, no. Always start with the debit, then credit. Always never start with a credit. Start with a debit, then credit. Yes. So on the bank account, on the credit side, you put here Tembo 1,500. On Tembo's account, we debited here, missing Tembo. We put here bank on the debit side 1,500. These are the ledgers. You have to make when you're making a trial balance, this is the process you have to go through. We're going through the accounting cycle. Yes. Each account, each account should have its own table. Yes. No, can have three transactions, not one person three times. No, three or more There can be as many transactions, but each account that you identify has to have its own ledger. Like here, have you seen? Each account that you identify in the transactions has to have its own ledger. All right. Yes. Mm-hmm. 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 All right. Then we have this one. Mary returned goods worth 300. So remember, Mary bought goods from us on credit. So she's our debtor. She's owing us money. Now, when someone who, yes, now when someone gets goods from you and is owing you money, when they bring back some goods, what happens to the money that they're owing you? Yes. All right. So in this transaction here, we have got two accounts. We've got Mary, who's our debtor, and we've got return inwards when a customer brings back goods. Okay. Return inwards is when a customer brings back goods. Okay. Return inwards reduces your income. Okay. So you have to debit. Yes. Return inwards is a contra revenue account or contra income account. Okay. Meaning it reduces your revenue or your income. Yeah, to increase the goods, but if they are damaged, even you have to discard the goods also. because there are many reasons why. Yes. So remember, when a customer brings back goods, that is return inwards. It's a contra revenue account, meaning it reduces your sales revenue. Okay, because initially we recorded a sales revenue of 1,300. Now goods of 300 have been bought back, so our revenue was also reduced. Okay, so you debit return inwards. So the journal entry is this: you debit return inwards 300. RI is return inwards. You debit return inwards 300, and then you credit. Yes, yes, because reduction in how much is owing us. Okay, reduction in a receivable. Mm, yes, return inwards. Yes, it's on top. It's being debited because it's reducing our income or our revenue. Okay, income or revenue increases with credit. Okay, so sales return inwards reduces your revenue. So that's why we are debiting here. Then Mary, since she's an asset to us, because whenever someone's owing, a debtor is an asset to you. So now, when the amount the debtor is owing you reduces, that's a reduction in your asset. So that's why we're crediting Mary. Okay. So did I make an agree? So Mary, here it is. Mary, we put here is return inwards 300. Then you open up a return inwards ledger. Should have its own. Every account you identify will have its own ledger. Mm. Here it is. One has come here. The duality concept of accounts. Yes. When one account is affected, another account has to be affected. Duality concept. Double entry. Yes. Then again, no, don't worry. Once you understand this, if as an engineer you're a problem solver, so these things are nothing compared to you. Mm. Mm. Okay. So the next transaction, Mary again has paid 700 kwacha. So the two accounts involved. Yes, no, here she's increased our cash. She increased our revenue. Yes, here she increased our revenue in this initial transaction there. So now, yes, here she's paying what she's owing us. Okay, she's not buying. Yes, unless she was unless it was a sale, then we would have said it's increasing her revenue. But here she's just paying what she owes. Okay. Yes. So this time the two accounts is cash and Mary. Both of them are asset accounts. Cash is increasing, so we debit. Increasing an asset, you debit. Mary, since she's paying us, so how much she owes us is reducing. So again, reduction in an asset, you credit. So we credit Mary and debit cash. Yeah, so the journal entry is debit cash 700. So let's put it on the ledgers here. On the cash account, we debit 700. Okay. We'll say Mary, we debit 700. Okay. And then on Mary's account, since she's paid 700, so it means she's no longer owing us. She's no longer owing us because, oh wait, no, she's owing us 300. She'll still be owing. But her Nkongole is dropping. Okay. Yes, that's why it's accounted for here. It dropped the Nkongole by 300, and then by paying, the Nkongole has dropped again by 700. Mm. Then the final transaction, purchase goods worth 7,000 by cash. So here, the two accounts, the purchases, expense. Uh-huh. Yes. But expenses, when you incur an expense, you debit. So you debit purchases expense. Then since we're paying by cash, so our cash balance is dropping. So reduction in an asset, you credit. Yes. So yes, yes. So purchases here, we're going to say here, cash 7,000. We debit purchases 7,000 here. Then on the cash account here, we credit. We say purchases 7,000. Okay. Yes. They won't bring a question like this for you, but here I'm trying to illustrate. There will be some questions where you need to close accounts. Okay, there will be some questions where you need to do some journal entries. So they won't bring a question like this. This is just for illustration purposes. Unless it's the whole exam, yeah. Unless it's the whole exam is recording transactions, then they'll tell you, okay, 100 marks. Record transactions, post to ledgers, make trial balance, and financial statements. That should be the whole exam because you can't finish. Yeah. Mm. So once we've posted to the ledgers, this is now where we make the trial balance. Okay, the trial balance. The trial balance is just used as a check to see if we've recorded our transactions accurately. And the trial balance can be from information we get from the trial balance, we can now use it to make financial statements. Okay, yes. So, as I said, when closing these accounts, okay, or getting the balances, you have got permanent accounts and temporal accounts. Permanent accounts are the assets, liabilities, and capital. Listen, assets, liability, capital, and also drawings. Also, I would put drawings there. These accounts, they have a balance that you carry forward to the next year. To the next year, have you seen? Mhm. Then you've got your temporal accounts, which are just your expenses and your revenue. Okay, these ones they have to be reset to zero at the end of the year. That's why they're temporal. They have to be reset to zero. Okay, yes. So let's start working on them. So cash, this is a permanent account. So this is how we close the permanent account. How we get the balance to be carried to the next year, right? You get the total on the debit side and the total on the credit side, and you see which one is big. So in this case, let's see total for the debit. Uh-huh. I'm fine. How are you, sir? I can get you, sir. Yes, the double entry is where you debit one account and you credit the other account. That's a double entry there. It follows the. Or you can ask. Yes, this is what you see here on in Excel here. These are what you call the ledgers. Yes, other or T accounts, but the official name is a ledger. Every time you are told to record a transaction, then it is about the double entry. Then from the double entry, you post to the ledgers. Okay. And as you are posting to the ledgers, it also applies to the double entry. Okay. Because each transaction will affect two ledgers. Okay, sir? Yes. You're welcome, sir. Okay. So this is how you close a permanent account. This is how you get the balance to the next. Could you mute your mic? Could you mute your mic? Yes. You get the total of the debit and the credit. Okay, so here the debit has got a bigger amount. So it's the amount you put here at the bottom. Okay, as you can see, 30,700, 30,700. Then at the end of the year, 31st December, you say your balance carried down. You're going to see this C/D. Balance carried down. It's just debit minus credit in this case here. Okay, it's just this 30,700 minus the 12,000, debit minus credit. Okay, so we're going to say 30,700 minus 12,000, 18,700. Okay, so the balance brought down to the next year. The next year starts, your cash balance is going to be 18,700. Any questions? It's just a matter of debit minus credit. So on your trial balance, okay, trial balance has also got a debit and a credit. So on your trial balance, you're going to put cash. Since the balance brought down was on the debit side, so you put here 18,700 debit side. Okay. Since the balance brought down was on the debit side, so we put 18,700 debit. Any questions before we go to the next account? Motor vehicle. Okay, motor vehicle, it's also an asset account. Okay, so here we've only got one figure on the debit side. So you put here 30,000, 30,000. So the balance carried down always comes on the lower side, which is the credit side. The credit side is zero. Let's say 31st December, balance carried down. We put here this same 30,000. Then 1st January, balance brought down 30,000. Okay. So on the trial balance, we're going to put motor vehicle 30,000 debit side. Okay. All right, we go to the next one. Capital. Also, capital is a permanent account, so we have to get our balances carried down. So, capital, as we can see, we've only got numbers on the credit side. So, the credit side is the higher side. So, you put the amount for the higher side 40,000 here, 40,000 here. Then the balance carried down, you're going to say 31st December, balance carried down, going to put here 40,000. And then on the opposite side here, you say 1st January, balance brought down 40,000. Okay. So for capital, it's on the credit side. So on the trial balance, we're going to put capital credit side 40,000. Any questions so far? Mm-hmm. Mm-hmm. Yes. Each of them has got their own column, debit and credit side. Okay, for bank, the total we compare debit and credit side. The debit side is higher, so you put the amount 5,000 here, the amount here 5,000. Then, as always, balance carried down comes on the lower side, the credit side. So 31st December, balance carried down. We're going to say 5,000 minus 1,500. Now, if you are doing such a question, you don't need to put this what I put in brackets here. Okay, you just get your value. The reason why I'm just putting it so you see how I'm obtaining the figure here. Okay, so 5,000 minus 1,500, 3,500. So balance brought down 3,500 debit side. Okay, so on the bank, balance brought down 3,500. Okay, so far we've just dealt with permanent accounts. Let's see. After bank, and we come to purchases. So this is a temporal account. This is an expense account. Okay, so it's a temporal account which needs to be reset to zero. So for this one, purchases, since we see the transactions are only on the debit side, so you just say 50 plus 7,000, 57,000. Okay. On the trial balance, you are going to put purchases. Just get the total of the debit, 57,000. Okay. Then to close this account, to set it to zero, so that the next year it starts at zero. Because you can't carry expenses from last year which you've paid into the next year. Okay. It will affect your profit. So here you're going to credit the purchases account. Okay. You put here statement of profit and loss. which is written as PL. This means just statement of profit and loss. You credit 57,000. Okay. So that this 57,000 on the credit side minus the 57,000 on the debit side, balance set to zero. Okay. Temporal accounts, the balance has to be set to zero. Any questions? Okay, we have Tembo here. We see which one is higher, debit or credit side. So it's the credit side. Okay, you can clearly see it's 50,000 is great. So you put the amount 50,000, 50,000. Okay. So on the lower side, you say 31st December, balance carried down. I'm going to say 50,000 minus 6,500. Minus this, minus that, 43,500. So on the 1st of January, 1st Jan, balance brought down 43,500. Okay. So on the trial balance, term, you're going to put on the credit side 43,500. Okay. Next, sales revenue. Okay, also this is a temporal. Any expense or income account is temporal. Okay, so sales revenue, you have to set the balance to zero. So you can see the only transactions are on the credit side. So you just get the amount 20 plus 1,300, 21,300. So you put this same 21,300 on the credit side. Okay, sales revenue 21,300. Okay, and then you want to reset the balance to zero again. So to reset the balance to zero, you need to debit. Okay, let's go sales revenue account. Set the balance to zero. You need to debit. So you debit statement of profit or loss, PL, and then you debit 21,300. Okay. 21,300 minus 21,300, zero. Account risk started. We have Mary here. Yeah, I wish I regret putting WhatsApp on my laptop on these group meetings. Okay, so Mary, okay, after the class, show me how to remove the notification because okay. Yes. So Mary, you say the total side is the debit side, 1,300. The higher amount, 1,300. Yeah. So the balance carried down at the end of the year, you're going to say 1,300 minus 300 minus. For example, let me just get some bundles that are about to finish. Let me just get some bundles. Okay. Yes. Minus 300. Yes, so our balance brought down 300 here. So for Mary, on the debit side, you put 300. So Mary 300. Yeah. Colleagues, I need to be shifting to another class. Maybe we can pause here for today. We can pause here.